Have you ever asked yourself what truly separates the wealthy from the poor or the middle class? Well, the answer is simpler than you might think. It's all about understanding two essential financial concepts: assets and liabilities. Assets are resources with economic value, things like real estate, stocks, or your own personal skills. They're expected to provide future benefit by generating income or appreciating in value. On the other hand, liabilities are what you owe. Think of your mortgage, car loans, or credit card debts. They're obligations that deplete your resources. Understanding the difference between these two is a fundamental step towards financial literacy and wealth accumulation. It's like learning the rules of the game before you play. Because let's face it, you can't win if you don't know how to play, right? Many people unknowingly accumulate liabilities while thinking they're assets, but today we aim to clear that confusion. So let's dive into the world of assets and liabilities. So, what exactly is an asset? Well, in the simplest terms, an asset is something that puts money into your pocket. It's that golden goose laying those shiny eggs of income right into your lap. Let's talk about some examples to help illustrate this. Consider a property you've bought and now rent out. The rent you receive each month, that's income. It's money flowing into your pocket thanks to this property. So, by our definition, that property is an asset. But assets aren't just physical properties. They can be as intangible as shares in a company or bonds from a government. When you invest in stocks, you're buying a tiny slice of a company. If that company does well and its value increases, the value of your slice also goes up. You can then sell your shares at this higher price and make a profit. Or maybe the company will pay you dividends, a sort of thank you gift for being a shareholder. Either way, it's money in your pocket, making those stocks an asset. Similarly, when you buy a bond, you're essentially lending money to a government or a company. In return, they promise to pay you back with interest. This interest is your income, making the bond an asset. Even a small business that you've started can be an asset. If it's profitable, it's generating income for you. Whether it's a bustling cafe downtown, a popular online store, or even a successful YouTube channel, if it's making you money, it's an asset. That's the beauty of assets. They're diverse, flexible, and come in many forms. But they all have one thing in common. They bring money into your pocket. And that's what being an asset is all about. It's not just about ownership, it's about generating income. In essence, if it's making you money, it's an asset. If an asset puts money in your pocket, what then is a liability? Now that's a thought-provoking question, isn't it? A liability, simply put, is something that takes money out of your pocket. It's a financial obligation or debt that you're responsible for. Let's illustrate this with some examples. Think about your personal car. Sure, it's shiny, and it gets you from point A to point B in style. But have you ever stopped to consider the costs associated with owning that car? There's the car payment, the insurance, the maintenance, and don't forget the ever-fluctuating gas prices. All these costs add up and subtract from your pocket, making your car a liability. Another common example of a liability is credit card debt. Those little pieces of plastic can be incredibly convenient, but they can also lead to significant financial stress if not managed properly. Every time you swipe your card, you're essentially borrowing money that you'll have to pay back, often with interest. So, unless you're using your credit card to generate income somehow, it's a liability. And how about your home? You might think of it as an asset, but if it's a high-maintenance house, it could very well be a liability. The mortgage, the property taxes, the upkeep, the repairs, the utilities, these are all recurring expenses that drain your resources. So what's the key takeaway here? It's important to understand that liabilities are not inherently bad. They often come with benefits and may even be necessary at times. However, they do cost money, and if they're not managed properly, they can put a strain on your financial health. It's also crucial to realize that not everything you own that you think is an asset is actually an asset. It could be a liability in disguise, steadily siphoning money out of your pocket. So, if it's costing you money, it's a liability. Remember, understanding your liabilities is just as important as understanding your assets when it comes to financial success. Now let's debunk some popular myths. You see, in the world of finance, things aren't always as they seem. Some of the things we've been conditioned to view as assets may in fact be liabilities. Take, for example, the widely held belief that your personal home is an asset. It's a comforting thought, isn't it? You buy a house and voila, you have an asset. But let's take a closer look. Unless your home is generating rental income, it might not be the asset you think it is. Why, you ask? Well, let's consider what it costs to maintain a home. You have to pay for repairs, upgrades, insurance, not to mention property taxes. These are all ongoing expenses that drain your resources rather than adding to them. An asset, remember, is something that puts money into your pocket. A liability, on the other hand, takes money out of it. So, unless your home is putting money into your pocket, it's not truly an asset. It's a liability. But wait, you might be thinking, what about when I sell my house? Won't I make a profit then? Well, that's a possibility, but it's not guaranteed. And even if you do make a profit, you've likely spent a considerable amount on upkeep over the years. Not to mention you have to live somewhere, right? So, unless you're planning to downsize or become a nomad, you'll likely reinvest that profit into a new home. This isn't to say that buying a house is a bad idea. Far from it. Home ownership can provide stability and can be a part of a well-rounded investment strategy. But it's important to understand the difference between an asset and a liability and to plan your finances accordingly. Remember, not everything that glitters is gold, and not every asset is truly an asset. So, next time you're about to make a big purchase, ask yourself, is this an asset or is it a liability? The answer might surprise you. Why does distinguishing between assets and liabilities matter, you may ask? Well, let's delve into that. Imagine you're on a financial journey, a path to prosperity, if you will. Now, this journey isn't just about earning money, it's also about how you manage that money. And the key to successful money management lies in understanding the difference between assets and liabilities. Think of assets as the golden eggs in your financial basket. They are the investments, properties, or businesses that put money into your pocket. They're your financial workhorses, tirelessly generating income while you sleep, eat, or enjoy your favorite pastime. When you accumulate assets, you're essentially building a money-making machine that works independently of your daily efforts. On the other hand, liabilities are the cracks in your financial basket. They're the debts, loans, or other financial obligations that take money out of your pocket. They're like financial leeches, constantly siphoning off your hard-earned income. When you accumulate liabilities, you're essentially digging a financial hole that's increasingly hard to climb out of. So why does distinguishing between assets and liabilities matter? Because it's the difference between building wealth and digging a financial hole. It's the difference between sailing smoothly towards your financial goals and being constantly bogged down by financial burdens. It's the difference between financial freedom and financial stress. The path to wealth is paved with assets, not liabilities. The rich understand this principle. They accumulate assets and minimize liabilities. They make their money work for them, not the other way around. This understanding allows them to build wealth, enjoy financial freedom, and live life on their own terms. If you want to join the ranks of the financially successful, you need to master this distinction. Learn to identify assets and liabilities. Accumulate the former and minimize the latter. This simple yet profound understanding can transform your financial landscape. Remember, it's not just about how much money you make. It's about how well you manage that money. And a crucial part of money management involves distinguishing between assets and liabilities. Your financial health depends on your ability to tell the difference between assets and liabilities. So equip yourself with this knowledge and set sail on your journey to financial success. So, a final recap. We've journeyed through the financial landscape, distinguishing assets from liabilities, and our financial literacy went up. Assets, remember, are resources that generate income or value, like a profitable business or a rental property. Liabilities, on the other hand, are obligations that drain your resources, like a high-interest credit card or an expensive car that's depreciating every day. We've dismantled common misconceptions, such as the idea that a fancy car or a big house is an asset, when in reality, unless they're generating income, they're liabilities. The importance of this distinction cannot be overstated. It's the cornerstone of financial success. It's the reason why some people grow their wealth, while others struggle financially. So, as you navigate your financial journey, keep these concepts in mind. Evaluate your decisions with a critical eye. Are you accumulating assets or liabilities? Remember, the road to wealth is paved with assets, not liabilities. The choice is yours to make. Thank you for watching today's video. Subscribe and like if you enjoyed watching. We'll see you in the next one.